Good morning, options traders. Well, I thought this would be a perfect time to talk about the risk premiums that we're seeing in the VIX during the coronavirus pandemic. And the main reason for this video is that one of the traders in our group here asked an interesting question last week, and he said, I noticed that on April 3rd, the spiders were down, but the VIX was also down. And doesn't the VIX move inversely? Isn't it a fear gauge? Well, that's partly true, and in the big picture it's true, but certainly not day to day. But to really make the most of the VIX and understanding why it moves the way it does, and to also use it as a technical indicator, and probably more importantly, to understand how to not step into traps in your options trading, let's take a look at the volatility risk premiums in the VIX. Now, this video is also related to one that I did recently on risk premiums in general, but now we're just going to relate it to the VIX. So first of all, understand that for option buyers, there's a difference between price and value. Buyers pay the implied volatility of the option, and that's what we might view as the current options price. But what do you get for that price? Buyers end up getting what's called the realized volatility, what actually occurred over that stock's life during the option. And that's what we might refer to as the options value. So as an example, just because you buy an option at 20% volatility doesn't necessarily mean it's a good deal if the stock's volatility turns out to be less than that. If you buy it at 20% volatility and it turns out to be more than that, yes, it's going to be a lot easier to make money in that option. Now, according to a pricing model, traders should be able to extract high volatility. So for instance, let's say that we see a $100 call trading for 20% volatility. That's the implied volatility. But the realized volatility, the stock volatility over the life of that option, is something higher, let's say 30%. If we buy that option for 20% volatility and we just delta neutral hedge it, we should be able to end up with a profit. That was the whole idea of the pricing model. It's another way of understanding an option's fair value. But there's a problem. The model assumes that volatility is constant, that it tends to stay in a steady band. But it doesn't. In other words, volatility is volatile. For instance, over here in the Thinkorswim platform, here's a 10-year look at the VIX, and you can see that it doesn't tend to stay in a narrow band, let's say between these two lines right here. Instead, we get big spikes, and then they're followed by these troughs, periods of very low volatility. Then we get these big spikes, and then periods of low volatility. So again, if you were to look at smaller ranges, yeah, the volatility in here might be very similar, but it's going to be very different from the volatility out here. There's no way we can measure this statistically and say that it applies to all time frames, and that's what creates the problem for traders. So again, a pricing model might say, if the stock is moving up or volatility is moving up, you should be able to hedge this at every little moment in time, every little fraction of a second, to keep that option delta neutral. Well, take a look at this. I mean, good luck. You get huge gaps. Look at this, big breaks in here. That's an immediate violation of pricing models. So traders have learned through School of Hard Knocks that option prices aren't necessarily indicative of what we can expect in the future. We can get these periods of very, very large volatilities. So now keep that in mind, and let's go back to when the pandemic first broke loose. During a time like this, we'd say this is high risk. So what do hedgers want? I talked about that in the risk premiums video, that the market can be loosely divided into two categories, hedgers and speculators. So who are the people that want the insurance when the market is coming unglued? Stock owners, investors. They're the people that want to go out and buy puts for insurance. And yeah, we'll also get some speculators in there as well who say, I think that the realized volatility might actually be bigger than what the market thinks. But the point is, we have a very big group of people who want to buy, and we don't really have a big group of people who want to sell. Why? Because of the asymmetric payoff of options. Option sellers get a one-shot fixed premium and then they've got unlimited risk. So how can the buyers entice the sellers? The sellers have to be speculators because they are the ones selling the puts, and the only way they're going to sell them is if there's a very big risk premium. In other words, that the premiums are probably higher than what they're worth. That, of course, doesn't mean that's going to be true, but that should at least be the expectation so that the sellers have some incentive to be short this option. They should have the outlook that prices will probably be lower in the future, and then they will step in to sell. Well, in order to get people to do that, you've got to offer excessively high prices, and that's what's causing the VIX to spike through the roof. But then what's going to happen? Remember, markets ebb and flow. When risk premiums go through the roof to absolutely historic levels, eventually people say, you know what? Probably better off being a seller up here. Or we could say that the hedgers are saying, I don't really want my puts anymore. Let me sell them back to the markets. Or let me sell some covered calls against my position. So now a lot of the hedgers are people who are sellers. And what do they need on the other side? A speculator who is a buyer. And the only way they can do that is to start dropping the risk premiums. So we get a lot of people selling covered calls nowadays. They said, well, I bought these stocks and I've got these sideways positions that are going on in the stocks, not really a way to make money, but hey, take a look at these really high risk premiums. Let me go out and start selling these. Okay, well, that's great if you want to sell them, but now you need a speculator to buy them. And so the speculators have to have some type of incentive that prices will probably be higher in the future, and that means the risk premiums have to be low, probably abnormally low. But it all gets down to supply and demand. The sellers are in high force right now trying to sell these very inflated options. So if we come over here to the E-Trade platform, here's the spiders, and here's a chart we've seen before. This blue line is the volatility of the stock, or in this case, the ETF, and the orange line is the implied volatility of, let's say, the at-the-money option. So notice when the pandemic first broke out, let's zoom in here a little bit, that the implied volatilities were higher than what the stock was delivering. And that was the risk premium. The people who are scrambling to go out and buy this insurance and these puts had to pay very high risk premiums. They had to do it here. But once the risk premiums get high, people turn around and then enter the markets to sell them. And if you need buyers on the other side, then you have to have a risk discount. So now the premiums are below. So even though you can see that the ETF is trading at right now at about 90%, the options are being sold at about 56%. So again, does this necessarily mean that people think that the volatility in the future is going to be down here at 56%? Not really. Probably going to be somewhere up into here, but they just have to offer these options at very big discounts to entice the buyers. But here's a really interesting thing to notice. You can see back here when it started breaking out, we were oscillating. But notice what's been happening here. They've been consistently falling, even though the volatility of the market has been rising. So it's a very good sign that traders are no longer willing to buy these risk premiums. Collectively, the market is saying we'd rather be the sellers. And so that's a very good sign that hopefully the worst of this is behind us. But the main thing to understand is that when you're looking at the VIX, don't think that it absolutely has to move in lockstep with the market. That if the markets are up, the VIX is down and vice versa. Instead, learn to look at it in terms of risk premiums, and that will help you to make a lot more sense when there seems to be these days when it's moving contradictory of what you'd expect. For anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course and strategy lab at optionsa2z.com. Also, please join us on the Facebook trading group Options A to Z, and you can find a link in the description below.